The Reserve Bank today left the OCR unchanged at 2.25%. Global financial market volatility has abated and the outlook for global growth appears to have stabilised. There has been a modest recovery in commodity prices in recent months. However, the global economy remains weak despite very stimulatory monetary policy, and significant downside risks remain. Domestic activity continues to be supported by strong net immigration, construction, tourism, and accommodative monetary policy. The dairy sector remains a moderating influence, with export prices below break-even levels for most farmers. The exchange rate is higher than appropriate, given New Zealand's low export commodity prices. A lower New Zealand dollar would raise tradables inflation and assist the tradables sector. House price inflation in Auckland and other regions is adding to financial stability concerns. Auckland house prices in particular are at very high levels and additional housing supply is needed. Headline inflation is low, mainly due to low fuel and other import prices, and long-term inflation expectations are well anchored at 2%. After falling in recent quarters, short-term inflation expectations appear to have stabilised. We expect inflation to strengthen, reflecting the accommodative stance of monetary policy, increases in fuel and other commodity prices, an expected depreciation in the New Zealand dollar, and some increase in capacity pressures. Monetary policy will continue to be accommodative. Further policy easing may be required to ensure that future average inflation settles near the middle of the target range, and we will continue to watch closely the emerging flow of economic data.
Governor, given that you've indicated that there's going to be probably another cut, what did you see as the major advantage of waiting?
Well, the interest rate projections we put out are always conditional projections, but there is one further cut that's built into there. That could change, of course, because it's dependent upon a number of assumptions about how the economy is performing, what might happen to the exchange rate, what might happen to inflation expectations. So you could end up in a situation where there is in fact no cut, or there could be more cuts. But we've built in one. In essence, when we looked at the economy, you've got an economy that's probably growing around 2.5% to 3%, and the forecast that we've got is for 3.25% growth over the next 12 months. We've got the global economy, which has been downgraded by several international bodies in recent quarters. Those downgrades seem to have stopped. Having said that, the World Bank yesterday cut its forecast for global growth. You've seen financial markets become more stable. The volatility that was there in January and February has abated. And if you look at this economy, there's a number of drivers that are supporting growth. You see it in terms of consumption. You've seen some significant real wage increases in the last few years. You've seen strong employment growth. You've seen strong tourism, strong immigration. All of those have added to be a driver of consumption. You're seeing a very significant amount of building taking place in terms of residential building and non-residential building as well. And at the same time, we've seen inflation expectations, which bothered us in March, and that was a major factor why we cut interest rates in March. And we'd seen those stabilise, and you'd seen oil prices pick up, but maybe a bit more inflation pressure starting to come through in the economy. And so for all those reasons, we felt at this stage we don't need further stimulus, monetary stimulus to the economy. and so we decided to keep interest rates unchanged.
The Policy Targets Agreement says that you look at a midpoint of 2% and a range of 1 to 3%. You've been below the 2% midpoint, according to these forecasts, by the time you get there for 6 years, and 2 years below the bottom end of the range, at least for CPI inflation. Are you meeting your targets on inflation?
I think you have to look at the language in the PTA, and I'd invite you to go back and look at a speech I gave in February, where the first half of that speech was focusing specifically on what did the PTA mean, why was there certain language put in there, what did that language imply for the actions of the central bank. If you look at inflation, and headline inflation is low, as you know, and it's low pretty well all over the world. The reason why it's low primarily is because tradables inflation has been negative for the last 3.5 to 4 years. And it's been low because world inflation's been low. It's been low because there's been an excess supply of manufactured goods worldwide, particularly coming out of China and East Asia. The same is true of capital goods, and it's also the exchange rate has been higher than what we would have wanted. Put all those factors together and you've got negative tradables inflation. That accounts for half of the CPI. We can't influence world inflation, obviously. We can't influence the excess supply of manufactured or capital goods. We have limited impact in a sustainable way on the exchange rate. The thing that we can influence is non-tradables inflation, and that's tended to run between 1.5% and 2.5%. That's the thing that we can have most influence over, and even that's been reduced by about 0.5% because of the ACC charges. Did you want to add anything, John?
It's perhaps worth emphasising that we are a flexible inflation targeter, so there's more to think about than just the CPI. And one of the things that PTA talks about is from time to time there will be deviations, and they may be quite large and they can at times be persistent. But the goal is to get to the target over time so that you protect the real economy, allow it to continue to grow if you can, and not unduly create other imbalances. And so I think, Bernard, your time frame is very short. You mentioned 6 years. If you take the arrangement where the PTA has said the target's between 1 and 3, that average over that longer time frame has been an inflation rate just over 2%. So in the long span of history, I think the bank's probably doing its job, and it's the framework that delivers that, not meeting by meeting, which you can do very little.